Welcome back to TalkTickers, where we break down earnings calls to give you the insights you need.
Yep.
Today we're diving into Phillips 66's Q3 2024 earnings call.
Yeah.
The energy market and refining in particular has been facing some tough times, and this call definitely reflects that.
It's a mixed bag for sure, but what's fascinating is that even with these headwinds, Phillips 66 managed to surpass analysts' expectations for earnings this quarter.
So let's dig into what drove that earnings beat.
Okay.
Was it their refining segment?
Actually, refining is facing significant challenges.
Really?
The real stars were their midstream and chemical segments.
Well, on midstream is performing well with the volatility we've seen in natural gas prices.
Exactly. Their midstream adjusted EBITDA is actually ahead of their guidance for 2024, clocking in at a whopping $3.7 billion.
Wow.
A massive leap from $2.1 billion just 3 years ago. You're seeing the payoff of their wellhead-to-market strategy here.
Yeah.
Remember that Frac 4 completion at their Sweeney hub back in 2022? That made it the second largest NGL fractionation hub in the U.S. Since then, they've been busy.
Okay.
The DCP Midstream acquisition, along with the recent addition of Pinnacle Midstream assets, has fully integrated their value chain. This means they're controlling every step of the process from the wellhead, where natural gas liquids are extracted, all the way to delivering those products to the market. That level of control is incredibly valuable in a volatile market.
So midstream is a bright spot, generating cash, even with natural gas prices being what they are.
Yeah.
That's probably a major reason why PSX stock is down only slightly today. Even with the tough refining market, it's like a built-in shock absorber.
Diversification is absolutely proving its worth for Phillips 66 right now. If you're considering PSX as an investment, that midstream performance is something to keep in mind.
Right.
But we can't ignore the elephant in the room, refining.
It's been a difficult period for refiners. The decision to shut down their Los Angeles refinery underscores the challenges they're facing.
This closure was a long time coming, driven by declining demand for gasoline and diesel in California. Mounting regulatory pressure and the high cost of operating in the state, it wasn't a sudden reaction to recent policy changes, but a carefully considered move.
So this closure signals a shift in the refining landscape, not just in California, but potentially globally.
It could be.
What does this mean for investors?
It raises a crucial question. What's the future of refining California? Might be a leading indicator of the challenges ahead for the industry as a whole.
It's a tough environment, but Phillips 66 hasn't been standing still. They've been actively working to cut costs and improve efficiency across their entire refining business.
And they've had some real successes. They hit their ambitious cost reduction target of $1 per barrel ahead of schedule.
That's impressive. But are those cost savings enough to offset the challenges in the refining market?
This is where things get complicated. Refining earnings are still below their mid-cycle targets. Even with those improvements, and it's not just a Phillips 66 problem, it's an industry-wide issue, refining margins, which is the difference between the cost of crude oil and the price of refined products like gasoline are still squeezed.
So how is Phillips 66 tackling this? Are they just hoping for the best?
Not at all. They're being very strategic. They're focused on small, high-return projects that are targeted to enhance market capture. Think of it like fine-tuning an engine to get the most out of every drop of fuel. These projects are designed to squeeze more value out of each barrel of oil they refine. On top of that, they're improving their integration and trading practices. Basically, they're optimizing their entire system to operate more efficiently.
And are these strategies working?
They're seeing results. They've implemented about 12 to 15 of these small, high-return projects each year in 2022 and 2023, resulting in a 3% improvement in market capture.
Wow.
This year, they have another 15 projects underway, and they anticipate these will add another 2% improvement.
That's encouraging, but refining is clearly facing some serious headwinds. And on top of that, Phillips 66 plans to revise its mid-cycle earnings capacity targets early next year. What's driving that decision?
There are a couple factors at play here.
Right.
First, they've made significant asset sales totaling $2.7 billion to date. That streamlining of their portfolio will certainly impact their earnings potential. And second, the refining market is in the midst of a major shift. Those factors necessitate a reevaluation of their targets to paint a more realistic picture for investors.
It makes sense to adjust their targets given the changing landscape. But this raises a critical question. Will mid-cycle margins be permanently lower going forward? This is something investors need to consider carefully.
Absolutely. And to understand how Phillips 66 is approaching this uncertain future, we need to look at their capital allocation priorities. They've been very clear about their commitment to shareholders.
Let's break that down for our listeners.
Sure.
What does that commitment look like in practice?
Their priorities are crystal clear. First and foremost is sustaining capital, which they've earmarked at about $1 billion annually. This ensures they can maintain their existing operations and invest in essential upgrades. Next comes the dividends, amounting to around $2 billion per year. This demonstrates their dedication to rewarding shareholders. Directly after that comes growth investments targeted at future-proofing their business. Then they allocate a substantial portion of their operating cash flow, at least 50%, to share repurchases. This reduces the number of outstanding shares, which can boost the value of the remaining shares. Finally, any remaining cash is directed towards strengthening their balance sheet and reducing debt. This prudent financial management ensures they're well positioned to navigate any economic storms.
So they're trying to find that sweet spot, balancing investments in future growth with rewarding shareholders today. It's a delicate act, especially in this market.
Precisely, but it speaks volumes about their commitment to creating value for both the company and its investors.
Now, beyond the big picture of refining midstream and capital allocation, there were some other intriguing details in this earnings call that caught my attention. For example, they mentioned strong LPG export margins. What's driving that?
It's classic supply and demand at work. Global demand for LPG is robust, but there's limited dock capacity to export it. This bottleneck is creating a prime opportunity for Phillips 66, allowing them to capitalize on those high export margins.
Interesting. Another point that stood out to me was their discussion of CP Chem, their chemicals joint venture.
Yeah.
Why are they outperforming in this environment?
They have two key advantages.
Right.
First, they have access to low-cost ethane feedstock, which keeps their production costs down. Second, they have limited exposure to the economic turmoil in Europe, which has been a drag on many chemical companies.
So they're benefiting from both low cost and strategic positioning?
Yeah.
It's a powerful combination.
Absolutely. And finally, there's one more interesting tidbit that I think is worth highlighting. Phillips 66 successfully produced sustainable aviation fuel, or SAF, in September at their Rodeo Renewed Energy Complex. This signals their commitment to supplying this growing market for lower emission fuels.
That's a significant development. The demand for SAF is only going to increase in the coming years. This could be a major growth area for Phillips 66.
It's definitely something to keep an eye on. It shows they're not just focused on the present, but are actively investing in the future of energy.
We've covered a lot of ground in this first part of our deep dive into Phillips 66 Q3 2024 earnings call.
We have.
We've looked at their performance in midstream and chemicals, the challenges they're facing in refining, and their capital allocation priorities. It's a complex picture, but I think we're starting to get a clearer understanding of how Phillips 66 is navigating this challenging market.
We've laid the groundwork now in part 2. We'll dig deeper into what this all means for investors and discuss whether PSX stock is a buy, hold, or sell.
Stay tuned for part 2, where we'll continue our analysis of Phillips 66. Welcome back to Talk Tickers. In part 1, we explored Phillips 66's recent performance, highlighting their success in midstream and chemicals, as well as the ongoing struggles in refining. But the big question for many of you is, what does this all mean for investors? Is PSX stock a buy, hold, or sell right now?
That's the million-dollar question, and it's not a simple one to answer to get a clearer picture. We need to consider several factors, starting with valuation.
All right, let's talk valuation. How does PSX stack up against its peers and its own historical performance?
Currently, PSX is trading at a relatively low price-to-earnings ratio, or PE ratio, compared to both its historical average and some of its competitors.
So does that suggest PSX might be undervalued by the market?
It's certainly a possibility, especially when you consider the robust performance of their midstream business. It's a reliable cash flow generator, even in a volatile market.
Their midstream segment really does seem like a rock in a stormy sea, providing stability in an otherwise unpredictable environment. And let's not forget their chemical business, which is also outperforming.
Right. Those segments help diversify their revenue streams, acting as a buffer against the ups and downs in refining.
It seems like Phillips 66 is well positioned to handle market volatility, but we can't completely disregard refining while it's facing challenges. Phillips 66 is actively taking steps to improve profitability.
Yeah.
Such as those small, high-return projects and their focus on integration and trading.
Those efforts are crucial. They're not passively waiting for the market to turn around. They're actively working to control what they can. If those initiatives are successful, it could significantly boost their earnings.
And that would likely translate into a higher stock price, right?
Most likely, yes. But we also need to be realistic about the risks. The refining market is notoriously cyclical, and a prolonged downturn could impact their earnings and potentially even their dividend payouts.
And let's not forget the regulatory landscape, especially in California. Their energy policies are creating a lot of uncertainty for refiners operating in the state. That's a wild card that investors need to keep in mind.
Absolutely. Those are valid concerns, but it seems that Phillips 66 is acutely aware of these risks and is managing them carefully. Their focus on diversification cost optimization and strategic investments suggests they're not gambling on the future, they're planning for it.
So after weighing the pros and cons, what's the final verdict on PSX stock? Should investors buy, hold, or sell?
Unfortunately, I can't offer any financial advice. My role is to provide you with the information and insights you need to make your own informed decisions.
Right.
But based on what we've seen in this Q3 earnings call, Phillips 66 has a lot working in its favor.
They're beating earnings estimates, generating strong cash flow, and strategically positioning themselves for future growth. It's almost like watching a skilled captain navigating a ship through rough waters. They're not just reacting to the waves, they're charting a course.
That's a great analogy ultimately. Whether PSX is a buy or a hold for you depends on your individual investment goals, your risk tolerance, and your assessment of the energy market's future.
That's wise advice. But here's something I think our listeners should ponder. With their unwavering commitment to returning cash to shareholders and their proactive efforts to improve profitability, could PSX be a hidden gem right now? A stock that's poised to outperform despite the current market turbulence?
It's certainly a possibility worth considering now while we're on the topic of uncovering hidden value. There are a few other interesting details from this earnings call that we haven't touched on yet.
I'm all ears. What else caught your attention?
Well, they mentioned their plans to wind down the rodeo crude operation. This involves preparing a number of the assets for demolition.
So why are they doing that? It seems counterintuitive to dismantle a potentially revenue-generating operation.
It's a strategic move. While there will be some upfront costs associated with the demolition, it will ultimately free up capital for other, more promising investments.
So it's like pruning a tree. You remove the dead branches to allow the healthy ones to flourish. They're optimizing their portfolio for future growth.
That's a great way to put it. They're focusing on the assets and operations that are most likely to drive value in the long run.
That makes sense. And while we're on the topic of optimization, let's discuss their refining capture rate. It held up pretty well in Q3, coming in at 92%. What's the outlook for Q4?
It's still early in the quarter, so it's difficult to say for certain. But historically, refineries tend to benefit from some seasonal tailwinds in Q4.
What kind of tailwinds are we talking about?
For example, higher butane blending volumes typically occur in Q4. This could potentially lead to a slight improvement in their capture rate, which would be a positive sign for investors.
So there's potential for upside in the refining segment, even amidst the challenges.
It's possible, but it's important to remember that the refining market is complex and influenced by numerous factors, both domestic and global.
All right, so far we've covered their performance in midstream chemicals and refining. We've discussed their capital allocation priorities and even touched on some intriguing details like the rodeo crude wind down and their capture rate. But we haven't talked much about the specific challenges they faced in the West Coast refining market.
That's a good point. The West Coast market has been particularly difficult for refiners lately. Phillips 66 highlighted several headwinds they faced in Q3.
Give us the rundown. What were some of the key challenges?
They faced weaker market cracks and feedstock advantages, lower margins driven by falling gasoline cracks, and the impact of crude deliveries and inventory drawdowns in a declining price environment.
It sounds like they got hit from all sides.
They did.
Yeah.
And on top of that, they're still dealing with the ongoing costs associated with the wind down of the rodeo crude operation.
It's a tough environment, no doubt, but it's a good reminder that even well-managed companies can face external pressures that impact their performance. What matters is how they respond to those pressures.
Absolutely. And Phillips 66 seems to be responding with a combination of prudence and proactive measures.
We've covered a lot of ground in this. Part 2, we've analyzed the investment implications of Phillips 66's performance, discussed the risks and opportunities, and looked at some key details from their earnings call. But we need to take a step back and consider the bigger picture.
That's a crucial next step in Part 3. We'll wrap up our deep dive by exploring some broader trends in the energy market and what they mean for Phillips 66. Stay with us.
We'll be right back with the final part of our analysis. Welcome back to TalkTickers. We've spent the last 2 parts of this deep dive dissecting Phillips 66's recent performance, their strategic decisions, and the factors impacting their valuation.
Right.
But now let's zoom out and look at the energy market as a whole. What are the larger trends at play, and how might they affect Phillips 66's future?
That's a crucial question. One trend that immediately comes to mind is the global push for cleaner energy sources.
Yeah.
This is putting immense pressure on traditional energy companies like Phillips 66, especially their refining business.
It's a huge shift in the energy landscape. How is Phillips 56 responding to this transition? Are they just standing by and watching the world change around them?
Not at all. They're making strategic moves to adapt. For example, their Rodeo Renewable Diesel project is up and running in Q3, produced 44,000 barrels per day of renewable fuels. And remember, their successful production of sustainable aviation fuel, or SAF, in September, these are clear signs that they're serious about diversifying into renewable fuels.
So they're dipping their toes into the renewable pool. But is that enough to offset the challenges they're facing in traditional refining? Will those efforts be enough to appease investors who are increasingly focused on sustainability?
It's a step in the right direction, but the transition to cleaner energy is a long and complex process. There's no quick fix. Phillips 66 will need to continue innovating, investing, and adapting if they want to remain competitive in a rapidly changing energy landscape, and they'll need to convince investors that they're serious about this transition.
It's a high-stakes game. Another major trend we can't ignore is the volatility in commodity prices. We've seen wild swings in oil and gas prices lately, and that uncertainty makes it difficult for companies to plan for the future. How is Phillips 66 navigating this turbulent environment?
Their diverse portfolio with strong performance in midstream and chemicals provides some insulation against commodity price fluctuations. And their proactive approach to cost management gives them additional resilience. They're not immune to market swings, but they're better equipped than some to weather the storms.
So they built in some shock absorbers to soften the blows.
Exactly, and they've consistently demonstrated an ability to adapt and thrive even in uncertain times.
All right, we've covered a lot of ground in this deep dive into Phillips 66. We've analyzed their financials, their strategic decisions, and the broader market forces at play. But before we wrap up, what's the key takeaway for investors? What's the big picture view of Phillips 66's future?
There's no doubt they're facing significant challenges. The refining market is undergoing a fundamental transformation, and the energy landscape is shifting beneath their feet. But they're not passively accepting this fate. They're taking proactive steps to address these challenges head-on.
They're diversifying their portfolio, investing in renewable fuels, and managing costs effectively.
Precisely. They're positioning themselves to not just survive, but to potentially thrive in this new energy landscape.
It sounds like they're a company worth watching closely.
Absolutely. They're a compelling case study in how a traditional energy company can evolve and adapt to a changing world. And with their commitment to returning value to shareholders, they deserve a spot on your radar.
Well said. We've reached the end of our deep dive into Phillips 66's Q3 2024 earnings call. We've explored their financial performance, their strategic choices, and the broader trends shaping their future. Hopefully, this deep dive has equipped you with the insights you need to make informed investment decisions.
As always, remember to do your own research, consider your individual financial goals, and consult with a financial advisor before making any investment decisions.
And join us next time for another deep dive into the world of earnings calls. Until then, happy investing.